Hi there. In today's video, we are going to study IFRS 15 revenue from contract with customer. Definition of IFRS 15 established the principle for recognizing revenue from contract with customers when control of goods or services is transferred. Revenue is recognized in an amount that reflects the consideration the entity expects to receive in exchange for those goods or services. So we have five principles of revenue recognition and also the criteria of contract. Once all five principles of revenue recognition is satisfied and also the contract criteria is satisfied, then we can recognize the revenue. First, we need to see the contract criteria. And definition of the contract is the agreement between two more parties and create enforceable right and obligation. The revenue recognition principles of IFRS 15 apply only when contract meets all of the following criteria. Contract criteria is the contract criteria is the parties have approved the contract and each party's right and obligation can be identified. So first, parties have approved the contract and each party's right and obligation can be identified. Payment term can be identified. The third one is the contract has commercial substance. If contract does not has a commercial substance, then this criteria is not satisfied. It is probable that entity will be paid. So sometimes that, for example, there is a company and we are going to do a contract with that company, and it is probable that company will have solvency issues. For that reason, company will not be able to be. For that reason, company will not be able to pay. Under this scenario, contract criteria is not met because it is not probable that entity will be paid. Now the five steps of revenue recognition principles. First, identify contract with customer. Second, identify separate performance obligation. Third, determine the transaction price. Fourth, allocate the transaction price. Fifth, recognize revenue when performance obligation is satisfied. We can recognize revenue when performance obligation is satisfied. Two ways of revenue recognition. IFRS 15 says revenue is recognized over time if any one of these conditions is met. Out of three, one condition is met, then we can recognize revenue over time. First one is customers simultaneously receive and consume the benefit. Example, cleaning services, consulting services. For example, we have cleaning services contract with a customer for 5 years. Then we are providing cleaning service, but we are providing cleaning service each day or alternative day. Under this scenario, we can recognize the revenue because we are fulfilling the performance obligation. So accordingly, we can recognize revenue whether weekly or monthly basis. Customer control the asset as it's create or enhance. Example, building a house on customer's land. For example, we are in a construction company and we got a contract to construct 5 floors building, but we have completed 1 floor. Now, in this case, we can recognize build revenue of 1 floor because we have completed 1 floor and we have transferred the position of that floor to the customer. So under this scenario, we can recognize the revenue. Third and last one is the asset has no alternative use to the seller and the seller has enforceable right to the payment for work done. For example, customized machinery we made only for that specific customer. So in this scenario, we can recognize revenue over time. Now the second is revenue is recognized at a point in time when control of the asset transferred to the customer. So at a point in time, we can recognize revenue when control of the asset transferred to the customer. Indicator the control has transferred, customer has legal title, customer has physical possession, risks and reward transferred, customer accept the asset, seller has right to payment. Now, there are 3 points which we need to by heart it. First one is if promise to transfer goods or services is not distinct from other goods and services in a contract, the goods or services are combined into a single performance obligation. So if the goods or services is not distinct with other goods and services, then the goods or services are combined into a single performance obligation. Second one is when change in the contract is minor like color, then contract will not be modified, it is revision. For example, we made a contract with a customer to provide them a washing machine. But after that, once we have made a contract, customer is now changing their demand. customer is saying that I want to change the color of the washing machine. In this scenario, there is no contract modification. It is called revision. Okay. Now the third point is contract modification or price modification is only happen when a scope of the product or price of the product is changed. Same example, customer, we are in a contract with customer and customer is saying, prior that we made a contract to provide them 6 kgs washing machine, but now they are asking us to provide them 7 kgs washing machine. So here the price modification we will have definitely, because 6 kgs washing machine price will be different and 7 kgs washing machine price will be different. So, and the scope of the product is also changed because it was 6 kgs and now we have now we are going to provide them 7 kgs. So under this scenario, there is a contract modification. Now, key point: a goods or services is distinct if both of the criteria are met. If both criteria are met, then goods or services is distinct. If both not met, then it is combined. Okay. The customer has benefit from the goods or services on its own when combined with the customer available resources. For example, we have two. So customer can get benefit from first one also and second one also separately, or when combined with the customer available resources, or when they combine both, so they get the benefit from both. The promise to transfer goods or service is separately identifiable from other goods or services in the contract. We can identify first one and second one separately. So this is simple example. Now we have consignee and consignor example and some general entries. Before that, we need to understand what is consignor and what is consignee. Consignor is a real owner of the goods, okay, and consignee is an agent of the goods. Once consignor send the goods to consignee, then consignee sell the goods behalf of consignor. Okay, so here consignee is selling goods behalf of consignor, so the consignee is not a real owner of the goods. Therefore, consignee will not record the goods in their books of account. Instead, consignor will keep their goods in their books of account. Now, journal entries. Principal means consignor when goods are sent to consignee. So this journal entry will be shown under the books of consignor. Okay. So so the consignor will pass the journal entry consignment account DR to goods sent on consignment. For example, we have goods that value has 100,000. So 100,000 DR to 100,000 CR. Now, when sale is made by agent or consignee, consignee account DR to consignment account. Then this general entry will be shown in the books of consignor. Now, general entry principal consignor for the commission to the consignee. Consignment account DR to consignee account. For example, we are taking that commission, we are paying 10,000. So consignment account DR to consignee account. Note: agent consignee will not record the sale or purchase. He will record the commission only, because here the consignee is only an agent. So agent cannot record sale or purchases. They can only record commission. They are getting commission because they are selling the goods behalf of the consignor. Now, cost to obtain a contract, non-incremental cost will be expense. Incremental cost will be amortized if it is expected to recover with the asset. Now, cost to fulfill the contract can be expense or asset. Expense: general and administrative cost, abnormal cost, cost relating to performance obligation that have been satisfied, costs that cannot be distinguished as resulting to satisfied or unsatisfied performance obligation. So these costs will be expensed, and the asset will be relate directly to the contract or anticipated contract, and general or enhanced resource with the entity will use to satisfy performance obligation in the future, or costs that are expected to be recovered. So all these three will be asset and all these four will be expense. Now, contract asset and contract liability. Company has performed the obligation and waiting for the payment. So under this scenario, we have contract asset. Company has performed the obligation and waiting for the payment. Now, contract liability: advance payment received. Buyer has already paid, but contractor is not finished the work. Okay, so in this scenario, we have contract liability. We can understand it simply: advance payment received for any contract, that is contract liability. Calculation, we can do this: revenue recognized to the debt we have, and this amount invoiced to the debt, and remaining will be that contract asset and contract liability. And this calculation is generally for when we recognize the revenue over the time. Revenue recognized to the debt and less amount invoiced to the debt, and remaining will be either contract asset or liability. Now, significant financing component. If the payment for the service or product is expected to recover after a significant period of time, then the receivable should be recorded at present value. Every year, the receivable will be unwinded. The increase in receivable will be recorded as finance income. So here a discount given or a coupon, this is the discount rate. Okay, we need to calculate the significant financing component with that percentage, and we need to unwind it receivables each year. Okay, now so the receivables value will be so the receivables value will increase each year. Now, bill and hold agreement. There must be substantive reason for the bill and hold agreement. Example: customer has requested because it does not have space for the product. The product has been separately identified as belonging to the customer. The product is currently ready for transfer to the customer. The entity cannot use product or direct it to another customer. If all requirement is fulfilled, then we will record revenue. Okay, under bill and hold agreement. Sale repurchase agreement and variable consideration. First, we need to see sale repurchase agreement. Sale is below fair value. So the sale, whatever we are doing, that the fair value, the sale should be below that fair value. Okay. Option to repurchase is below the expected fair value. Also, option to repurchase is below the expected fair value of that product or services. Entity continues to use the assets. Okay. Entity continue to hold the majority of risks and reward associated with the ownership of the asset. Sale is to a bank or financing company. Okay, so this is the sale and repurchase agreement. Now, variable consideration. First, what is variable consideration? The variable consideration is the part of the transaction price that is uncertain because of it depend on the future event. Okay, record revenue up to the amount that is not expected to return. For the amount that is expected to be returned, create a refund liability. Calculation of variable consideration, there are two methods. First one is expected value method. Second one is most likely outcome non-cash. Okay, now first one is variable consideration including non-cash consideration. Basic rule for variable consideration: variable consideration equal to part of the transaction price depend on the future event. Example: discounts, rebate, performance bonuses, penalties, return, of return. Non-cash consideration whose value can vary. Steps: we have estimate the variable amount using expected value or most likely amount. Apply the constraint, include only the amount that highly probable not to result in a significant reversal of revenue in future. Right of return, example point 1 and point 2. Record revenue up to the amount that is not expected to be returned. Okay, for the amount that is expected to be returned, create a refund liability. We need to create that. Now, example, we have suppose that you sell goods for 1,000 and expect 10% will be returned. Keep expected kept by customer is 90%. So 90% we are having that 900 and record revenue of 900, because we are assuming that 90% 90% will not be returned, only 10% will be returned. So revenue will be recognized till 90%. So 900,000 will 900 will be revenue expected to be returned 10%, that will create refund liability. Also recognize an asset for the right to recover the goods at carrying amount, not selling price. Example: DR asset inventory to be recovered, CR cost to sell. This is how variable consideration returns work. Okay, so here it is about variable consideration returns. Now, two methods to estimate variable consideration. First one is calculation of variable consideration, two allowed method, expected value method and most likely outcome method. So expected value method is used when there are many possible outcomes, lots of contract volume discount etc. Multiple each possible outcome by probability, then multiply each possible outcome by probability, then add them up. Okay, so this is simple. For example, bonus can be 100, 0, 100 or 200 with probability 20%, 50%, 30%. So 0 multiplied by 20%, 100 multiplied by 50% plus 200 multiplied by 30%. So total will be 110. So this will be expected value method. Now, second one is most likely outcome method. Use when there are only two outcome, bonus or no bonus. Choose the single most likely amount. Example, either receive 0 or 100 and 100 is most likely. So choose 100 as the estimate, then apply the constraint. So here the 100 will be our value. Okay, then we need to apply the constraint. Now consideration. If the payment received is a non-cash item, then fair value of the item will be revenue recorded. If the fair value of the non-cash item cannot be determined, then a standalone selling price of the goods or promised service to the customer will be revenue recorded. Under the first point, non-cash item we have, fair value of that item will be our revenue. Under the second point, non-cash item we have, determine the transaction and we cannot determine the fair value of that item. So a standalone selling price of the promised goods or service, the customer will be revenue recorded, means customer will record the revenue of that standalone selling price. Now warranty, assurance type warranty, we need to create estimation while sales how much it will cost for the year. For example, at the time of sales, we sold the sales value is 100,000 total. Now we are assuming that $1,000 goods will return. Okay, so $1,000 goods value we need to create estimate liability. Okay, and if it is incurred, then it will go directly from the provision estimate provision that estimate liability. If it is not incurred, for example, if we haven't received any complaint and any defective product, so that at the end of the year all the amount will be discharged to the revenue. It's not just end of the year, it is like entire assurance type warranty period. For example, assurance type warranty, generally electronic products, we generally have assurance type warranty. For example, as on a smartphone we have 1 year or 2 years warranty. So this is assurance type warranty, we do not pay any money for the assurance type warranty. Okay, on the other hand, for the service type warranty we need to pay it. For example, we took additional 2-3 more service year warranty, for that we need to pay. Each year liability will be created and the end of the year, if it is not incurred, it will goes in the revenue, and if it is incurred, it will goes in expense at the date when it is incurred. Okay, so each year we need to create the liability. First, we will take that amount as a revenue, and each year we need to create the liability. Okay, if it is incurred, if it is uh, once we receive the payment, then we will create the liability, and once if it is not incurred, then it will goes to the revenue. If it is incurred, then it will goes to the expense at the date when it is incurred. Now, if performance obligation is satisfied over time, revenue is recognized using point or input in point or output method. If not satisfied over time, revenue is recognized at a point in time. Under IFRS 15, you can only recognize revenue to extent of the asset's fair value. For example, assets value is total 1 million. Okay, and no, asset sales amount is 1 million and assets fair value is 900. So 900 we can recognize under revenue. Anything above fair value, for in this scenario we have 100,000, can't be treated as a profit on sales because economically it is not a sales, it is financing. Okay, so here it will come under financing, not under profit, because we sold for 1 million. Apart from the fair value, 100,000 will be our profit. No, it will not be our profit, because under as per IFRS 15, anything above fair value cannot be treated as a profit on sale. Now, non-refundable is not a separate performance obligation. Example, gym charges, we pay 1,000 registration fee. Once we pay registration fee, we didn't get any kind of services. just after paying registration fee. We need to take that membership. Okay. So, but registration gives no real services, because after paying registration fee, we didn't get any kind of separate services. So for that reason, it is not a separate. Okay. It is combined on entire contract price. This 1000 is just spread over contract price. For example, we can understand with months. We took the service for 5 months, means we pay 5 months membership. So this 1000 will spread over 5 months, spread over the time. Note, when customer buy one goods and services, and then we offer another goods or services for the free or at discounted price, or any loyalty program that is separate performance obligation. Non-refundable is a separate performance obligation. Here we have separate performance obligation. If non-refundable fee is for real service, it is own performance obligation. So for example, we paid 1000 separate fee, and that is non-refundable, and we got a trainer. So that is a separate performance obligation, because we paid that fee and we got separate performance obligation. After paying that 1000, we got a trainer. So here it is separate performance obligation, because we got a real service. Now formula practice we need to do. Example price 100 we have. So this is very common that in the exam they are asking markup and margin. So what is markup and what is margin? So markup is like, for example, they are asking markup percent 20. So 20% markup means multiplication. 100 price of the goods or services whatever we have, and markup percentage is 20. So 100 multiplied by 20 will be 120. Okay. Margin means division. Okay. Margin percentage means division. 100 price we have, so now 100 will become 80%. So 100 divided by, sorry, yeah, 0.8. So 100 divided by 0.8, it will be 125. So 125 our final price. So we got 100 20% margin on 100. So 125 will our final price. Now standalone formula. Actual multiplied by individual divided by should be. This formula I made it to make it simple. Now we can understand this. What is a standalone? Standalone is generally used for when we have a combined price, and individual price is different, and combined sales price contract price is different. So here a smartphone price, for example, 350, and laptop price we have 750. So total price will be 1100. Okay. But here we have sales price 1000. Okay. So now we need to find it a standalone price of a smartphone. Standalone, sorry, standalone price of a smartphone. So actual total means entire total. Okay. Entire total, actual total means contract total. Total contract price instant we can write this. So total contract price we can see that is 1000. 1000 multiplied by, here individual price of a smartphone is 350. So 350 divided by uh, what is the amount, should be means what will be the price if what will be the total normal price, okay, without considering this final price. Okay, so we need to just add it, 350 plus 750, it will be total 100. Sorry, 1100. 1100. Now 318 point, okay, round of 318 will be our standalone price of laptop. Laptop, we can do 1000 multiplied by laptop price is 750. 750 divide divided by 1100. So 682 round off. This will be a standalone price of laptop. So that's how we can calculate a standalone price of each product. Okay. Thank you for this video. In next video, we will study different topic.